Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, and I have Minyi Chen on the line. He's an executive vice president and portfolio manager for TrimTabs. How you doing this morning?
I'm doing fine. Thank you, Joe.
Thanks for coming on the show. Could you just give us a little bit of your education and your market background?
Absolutely. I grew up in Shanghai in China, and I came here in 2007 in California with my family. And actually, when I came here, I already finished my college back in Shanghai, so I was doing a business major, and also I started my job. My first job was for ZTE Corporation. It was the largest telecom equipment provider in China, so I was their international finance manager. So I actually spent quite some time around the world before I came here, dealing with different clients, mostly in emerging markets. And after I came to the U.S., I joined with TrimTabs. That actually was my first job in 2008, and I've been staying with the firm since then. So I started as a equity strategist and helping the company to cover the global market. And the firm's position has always been that supply and demand matters in terms of stock prices. So we actually, over time, I helped the company to devise a lot of new strategies that apply the same methodology to different markets. So in 2011. We partnered with Advisor Shares, which is a ETF advisor. So we supplied a strategy and worked on this particular ETF called TrimTabs Float Shrink ETF with them, and we launched that 3 years ago. And now we're sitting at around $150 million, and we just got our 5-star Morningstar rating for the fund.
And what's the symbol on that, on your ETF?
Yeah, the ETF I manage, the ticker symbol is TTFS. That's Tom Frank Sam.
Yeah, I looked at the chart of that thing yesterday, and I'd have to say you're doing one hell of a job there. That's a pretty looking chart. But let's go back to TrimTabs here, and you guys subscribe to the liquidity theory, and it has a couple different tenets in it. Could you just to describe the liquidity theory and the basic tenets and what you look for?
Sure. In the stock market, all that exists are shares. Shares are a countable thing. Every company has a specific number of shares outstanding, and if you think of it as a certain commodity, that is the supply of that commodity, and on the other side is the demand. So, for example, if you have an increase in supply, when you have a wave of huge IPO secondary offerings like what we had in the IT bubble period of time, you could have a market where the shares outstanding could double in a few years, and ultimately, if the demand cannot catch up with that supply increases, the price will crash and correct, and the supply and demand balance will move it back to the balance point. And same thing, if we have a shrinking in supply, a decrease in share supply, and you don't need a huge increase in demand to drive the stock price higher. So that's the basic theory of liquidity theory. So if you invest in the stock market, you want to avoid certain stocks or a certain period of time when the shares outstanding are surging, but you definitely want to be in the market when the share supply is declining, or it's basically remains flat.
So you're emphasizing. I mean, you're really looking at volume figures at kind of dictating over price, or is it a combination of the two?
I think it's we focus just on one thing, the supply and demand change and the change in that dynamic. The share price, I don't think it's a concern to us because, if you have the demand, it doesn't really matter, how much the stock or the market is selling for, right? If you have people wanted to take a bet to take the risk on the stock market, those demand can continue to drive the market higher. In our view, I think, the supply and demand equation has a bigger impact on the market than, the stock price itself or the valuation of the stock itself.
Okay, and how much tell us about your emphasis on macros.
You mean right now for this market?
Yes.
You know, that's a very good question. So if you think about, I think I'd look back, you know, in the three, uh, you know, boom and bust period of time. You know, look at stock market since 1995 to 2001. In those years, the stock market, the shares outstanding rose by 120%, and subsequently, when the stock market crashed after the bubble busted in early 2002, since then until you know just before the financial crisis in 2007, 2002 to 2005. Those years, the market share supply increased by only about 20%. So that's a much slower pace than it was in the first during the 90s. And then when the market crashed again in 2008, and now looking back from this point back to March 2009, you know, when the market was at the lowest, you know, guess by how much, you know, the share supply increased. It only increased by less than 5%. So, you know, I think currently we haven't seen a huge increase in the share supply at this point, and for that reason, we think you know the market could go much higher because I think the liquidity theory dictates that if you don't have increase in supply, you just only need to move the demand to drive the stock prices, and that's why I think you know the market can be very bullish for an extended period of time.
Okay. And tell us about your research reports. How often do you put them out, and what kind of content do you put in there?
And we provide different flavors or different contents in different reports. So we have a daily report that summarizes the daily liquidity event, you know, any IPOs, secondary offerings, mergers and acquisitions, insider buying and selling, stock buybacks. It's a daily summary and also including, you know, mutual fund, ETF flows, all that. We also provide a weekly piece with specific topics, you know, like, you know, we have a weekly flow report, which just describes everything, you know, in fund flows. And we have a kind of a weekly recap for everything. It's called a weekly liquidity review. So, you know, for most of these research reports are really for institutional investors, and we supply these research and including our proprietary data to many hedge funds and also money managers.
Okay, we are on the line with Minyi Chen. He's the executive vice president and portfolio manager for TrimTabs. You track a lot of data there. I mean, besides, you know, what do you use to calculate the supply and demand? Are you just looking at the daily volumes? Do you kind of, you know, do you try and account for any outstanding, you know, options that could have a potential effect on the stock? What other data do you keep track of to make your determinations?
So, you know, you start with the shares outstanding. You know, that is the number that the company announce at least on a quarterly basis. And then you have all kinds of events that could have an impact and change that number. For example, you can have stock buybacks that goes on, you know, probably every day or every month. You could have insider transactions. You know, if the CEO or you know, the biggest shareholders, if they are buying or selling the shares, that could change. You know, to clarify, you know, for the specific strategy for TTFS ETF, we use the terminology called the float. The float is the number of shares that actually investors can buy or sell on a daily basis. So if this is a CEO is holding a certain amount of shares, we consider those are stagnant shareholders, stagnant shares. So you know, if Mark Zuckerberg holds his shares of Facebook is not tradable by retail investors because it's not usually for sale unless he do it through a certain period of time. So we care about the float, which is the real number of shares that can be bought or sold on a daily basis. So other than those things I just described, you can also have
Okay.
like what do you call this hedge fund. If Carl Icahn is buying 20% of Herbalife, like he did in 2013, then that was a event that shrinks the float of Herbalife. So these are the things we track, and it's quite comprehensive. And because of the dynamic of the market, for the companies in our portfolio, these things could change every day.
Okay, and you guys also dabble in the managed futures a little bit. If it looks anything like the chart of your ETF, you guys must be doing pretty good.
Yeah, it's also a partnership with another external manager. So the managed future business is we created a fund that uses a proprietary market timing index. It's called the TrimTabs Demand Index, and that is kind of a regression model based on 21 different liquidity variables. And to me, I think the easiest way to explain that model is it is really a model that's very different from the market. It's not like those typical technical or momentum following, trend following models. It looks at what the market is doing. Ultimately, supply and demand is a is something that shows the risk appetite on the market. So we look at these things. Whether there's a big risk appetite for investors to take on risk, or or the other way around. So it's been quite successful. We've been running the model since actually before the most recent financial crisis. We started in September 2008, and the model has been performing terrifically. And this is a managed future we use. We use the futures on the S&P to express our position on the market. So it can go from shorting the market, 100% short on the S&P to double long the S&P. So based on our timing tool, we will adjust the positions on the futures accordingly.
Oh, so you'll go double long or you'll go short in that thing as well. Very interesting. Well,
Yep.
just looking at the chart of your ETF here, it's just busting out here the new all-time highs. Could you just, give us your outlook here, for the market, perhaps for the remainder of the year and going into 2015?
Sure. It's obviously the market has been doing very well. If you look at S&P or Russell 3000 index, those broad market indices, they're all at an all-time high right now. And a couple of things give me confidence on this market. First of all, we had a really strong economic growth in the past 2 quarters. We had a rough winter this year, but summer and the fall did really well. And I don't think that the end of QE3 is a very negative thing. I think the Fed has been preparing for this for a long time, and the investors are very much prepared for that. So I do not think that has an impact on the market anymore. Going forward, coming back to our liquidity theory, we haven't seen there's any sign that the market is going to have a huge increase in share supply, which remains, the situation remains bullish for the stock market. In the short term, we think there might be a little bit volatility just because we saw a huge inflow into ETF funds in the past 4 weeks. We had about $33 billion of inflow into U.S. equity ETFs, and that is about five times the year-to-date average. So we think there is a little bit, maybe a little bit, the market is becoming a little bit too hot just because of the money flow. Everybody is trying to chasing the returns, and obviously, everybody knows that usually doesn't work. So in the short term, I think these kind of over bullishness is going to bring the market volatility up a little bit, but I think to the medium or long term, I'm still very confident the market could go higher. We have a lot of demand in equity investing, and on the supply side, we have literally no increase in there. So from that perspective, I think we're good for 2015.
Okay, Minyi Chen, Executive Vice President and Portfolio Manager for TrimTabs, explaining his approach to the markets, supply and demand, the liquidity theory, also shedding some light on his managed futures that they use on both sides of the market, which is always good. Well, thanks a lot for coming on for your outlook on the market, and we certainly hope to have you back on Benzinga's Pre-Market Prep again.
Hey, thank you for having me, Joe.
Okay.
Have a nice day.
Have a good day.